Hey guys, so for today we will be having our lesson over the VIX and how you can use it to help with trading. So what exactly is the VIX is often referred to as a fear gauge for the market. It's it's used to measure the forward-looking volatility based on the market's expectations. So how do we calculate the VIX? You don't really need to know it, but it's good to understand the concepts behind what it actually is before you using it so that you're not using it for no reason. I'd always like to trade with a understanding of what's actually going on. It's calculated based on a range of different options on the S&P 500 index. So oftentimes if you know much about expected movement of stocks, usually the at the money straddles or is the price of the expected movement. So this idea is used to create a weighted average on a number of different explorations on XBX index. But I want to stress that the VIX is not based on historical volatility. It's implied volatility, which means it reflects the market's expectations for future volatility. It doesn't measure anything in the past, but rather what traders are currently paying for volatility, like what they're assuming to be priced in of the XPX volatility. So, two things I like to use for VIX is the VIX spreads and then the VVIX. It's like the volatility VIX. So we'll go over that later. So for VIX spreads, what exactly are they? So the VIX spread is essentially the difference in the VIX calculations of two different price points. So if you know about futures, you know that, or even options, there are different expiration cycles and they have different prices for it because what the price is now is not necessarily what it's going to be later because of time. So that means that there's a difference in pricing of these. And this gives us some information, some very important information on what the market expects between two different periods, either now and later or between two later dates. So in order to calculate the VIX spreads, you have to take the difference between 2 months. And I will share my screen to give some visuals. You guys give a thumbs up in the chat when you see it. All right, good. Okay, so firstly, it's the VIX. We all know what it's like. So this is the VIX for the overall VIX, like 30 days, and this is the VIX for the 6 months. You can see that there is a difference in price. Because I didn't make them percentage based. I made it based on the actual dollar value, the scale. So you can see that most of the time, the 6 month VIX is higher than the average VIX, which means that there is usually more risk in the future, if that makes sense, due to time. there's always going to be more risk. And that's even why we pay for data and ID on options. So a good kind of picture for this kind of concept is because this is kind of hard to work with in terms of data. There's two different types of representations I like to use. There's there's this one. You guys see this part? You guys see this big curve? Okay. So this is what it looks like today. So these are, I mean, the numbers are kind of high right now because we're expecting not a lot of volatility right now. It's 12.5. So the slope of this curve is a little bit steep, I would say, but this is the general shape of a normal curve. You can see that it's the lowest risk right now. So obviously, we're bullish, but later on, it could be not bullish. The chances of being not bullish is, let's say, a little bit higher here, and then it starts to fade out again. But there is a different kind of way that this could go. Can anyone take a guess in the chat of what it would look like in different market conditions? So in different market conditions, you can see that this I took this chart from March 12th, 2020. This was during the COVID crash. You can see that the negative number is very steep, negative 20%, negative 20%, negative 10%. And you can see that the curve ends up actually looking like this because on that period of time, the most risk was then. Like COVID could have gone away later down the line, but it was there for sure at that point. And you could see on here that the current month curve is way higher than the 6 month curve here, which is represented by the negative. Another way to represent it is I like to use calculations for it. So this calculation is the 6 months minus the 3 months and then divided by the 3 month period. So what this actually does is it calculates the percent. It's a little bit off depending on which actual fixed expiration you use, but this is like a rough idea of how the curve looks. Like if it's flat in one area, it's probably gonna be flat in other areas. If it's upsloping in one area, probably going to be upsloping in a different part of the curve. So it's good to simplify it down. So you're only looking at one part of the curve sometimes. So what this helps to indicate is the percentage contango. So what is contango and backwardation? The contango is basically like the normal market conditions I showed you earlier with the curve being sloped up like this. This is in contango and this is backwardation. So what can we, okay, so after recovering backwardation contango with the big spreads, There's another thing I like to use, but I will go over more analysis later. This is the VVIX. It's there's not much for me to show you here until later, but this is a good indicator of, for example, if the VIX moves up, usually with in the inverse of spot. So when volatility goes up, VIX goes down. But the VVIX is taking the volatility of that vol, which means it's kind of like the acceleration instead of just the velocity. It's like a derivative. So this gives a little bit of a sooner indication than the VIX. Let me show you. So I took the inverse of VVIX and the inverse of VIX usually because this inverses the chart. So it flips it upside down so that because SPY and VIX are inverse, when you flip one of them, it makes it so that if VIX goes down, SPY also goes down, so that you don't have to like keep flipping there. Right? So with this, you can see that oftentimes it seems that the VVIX will move for the VIX. You see that the VVIX bottoms first. Like here, it bottoms and starts to make a divergence a little bit. See that it's moving in opposite direction because the VVIX is going first because it's the derivative. The acceleration always moves forward with the velocity negative or positive. So that pretty much covers the actual topic, broad overview and definition. So we'll go over some example uses. So things I like to use with the VVIX and VIX spreads. There's this idea of leaders and laggers in the market. I kind of talked about it a little bit with this thing going on where the VVIX usually moves before the VIX does. Like you can see here, this is like kind of flat, but this is already making lows or higher lows. So that means this leads this. And VIX usually either moves very, very slightly before or in line at the same time. So that means that if VVIX comes before VIX, that also means that it comes before SPY, which I have here. As you can see here, SPY hasn't bottomed yet, but then it will, right? Once it breaks out of here, SPY starts to have a reverse. And goes for a lot of different, right here. You can see that the VVIX starts spiking right before SPY even really. But then it starts to trail off during the top. It's a good indicator, like any type of reverse. It doesn't have to be necessarily a crash. Sometimes it can just go sideways. And the same thing goes for the VIX spread. It also helps to determine the beta. As you can see here, this starts to pull back even before SPY because this is the market expectation. they're starting to go down. The difference between them is going down, which means that the whole curve is shifting. It's a reversible. So we talked a little bit about what a leader and what a lagger is. So now we'll go over some tools to help you with that. So one of them is just simple, kind of like support and resistance, like SPY, like you would use in SPY, but I like using it better with fixed kind of warning indicators because it's usually more stable where the pivots are. For example, if you look here, you can see that like these are always near, and these are always near. They bounce pretty consistently. Whereas SPY, you have to go and like calculate the roughness, see how far down you go. Here you kind of like have a good idea of where it's about without actually like calculating. And the tops are even better, right? Like this one comes and drops before this little pullback happens. This starts to drop before that pullback happens, right? And this starts to rally before that does. It makes a big stop hammer. They say the same story, right? You could, if you were to draw like a line, once it gets up to this level, right? You can be careful. Like for here, for example, we got up here, and it's very, very, very good indication that it's about to drop, right? And you don't really have to do much, bids or calculating support and resistance because this is a lot more consistent. Because the VIX only ranges in certain values. It doesn't really go like SPY could just keep going to 5,000, but VIX won't drop from zero. Like it once it gets to like 12, it'll just start to slow down. And because this is more stable, you could add things like a RSI. This is, I'll go over that later. This is the RSI, and you can see that these are also very, very easy to read. Like what is this like? 60? Yeah, 60. It's 60 60. You can see that every time it gets here, it makes it drop, and vice versa with both. If it gets to around this 50, it's 40, 40, 41, 42 level, right? It starts to have like, and you see that here, right? Our side starts to bounce like way before the market. And here it's so early, right? This is like such a good indicator that the market's gonna rally so close in timing, but just slightly before. You can get in right on. So the other tool I wanted to cover is using correlation. So the correlation is the similarity. It's like a similarity score almost between two forms of data. It's the R squared is it means the least square regression. So it's like this is the this is the how do I explain this? This is the it's, yeah, it's just basically so when you have the similarities for -1 being that they're moving in reverse and one meaning that they're moving completely together and zero meaning that they're not really moving with each other or against, they're kind of just doing their own thing. So when it goes negative, that means that there is a price discrepancy between buy I set this to XPX, so it's comparing against XPX. So once it goes negative, it's the 3 period, but once you have the negative happen, that means that this ticker, the the VIX or the VIX spread, whichever one you're looking at the moment, you can see that once this goes negative, that means that this has started to come down. So the leader, right, the leader has started to come down, but the lagger being SPY has not started to, right? It has not pulled back. But after a little bit, SPY catches up, and then you see that it goes back to being positive. SPY makes that back. And how would you use this in trading? When this goes from -1 to +1, it goes from very, very inverse correlation to very, very strong positive correlation, which means that the lagger starts to catch up to the leader. So this is the point at which it's almost like the confirmation that XPX has finally agreed with what VIX has been saying. Because you don't necessarily want to get in the first instance that VIX starts to disagree and lead away from the spot. Because it could just be a consolidation. But once you have this moment where it goes back to positive and it's sharply like down here, right? You know that, oh, right, that's the reverse. And you could use the with both of them, right? This and the VIX, which are both the leading ones. The VIX is basically in line spot, so it doesn't really give us a good warning because it's just the same time. So here you can see that when it goes from negative to positive, right? Which way is it going? Oh, it's going positive, right? So here and then this is probably not a good thing, but this one, right, jumps back positive, right? With the V between down, with the down move. And the same thing happened here, right? The spread, right, is making lower highs so that while this spy has not, right, at this point it hasn't, whereas this has. So that means that it's negative, right? This is positive, but this is still negative. So when you multiply positive by negative, you get a negative. So once it snaps back, you know that, right? This moment of snapback where it starts, price starts to catch up and agree, then you can see that that's right where the pivot. So that's pretty much it for the lesson. I'll go over 1 or 2 more examples if you have questions. Oh, you could also, like I mentioned, use the support and resistance lines just like the it. You can use it here, so on either one of them. This project from here, this size is here. You see that when it gets up here, it's going to pull back there. Because it's up here, there, the one up here, up there, down here, it makes it pull back there. And then you see the see that our side around here has bounce, right? A little bit before, right? The R side bounces before the spy bottoms, right? And then here, right? Once again, our side is here, but this is double bottom, right? This is lower highs, right? It's fine, not bottom, right? Why? Because this is leading spot. It's fine and react to and your pivot. You see up here was the bear market levels, right? It differs depending on which kind of market you're in, because in a bull market, obviously there's less volume. So this level is lower than the bear. And that's just something you have to figure out based on the spike. Right? Big spike down in volatility. Oh, that's a big indication of the routine. Right? Let's do a few more art. Right? Here, you see this level of support, able to bounce with the negative positive. Right? Here, right? Bounce. Right? That's another one. Pretty much work anywhere. You just gotta figure out where the bubbles are, which is easier than slot. There's only like two calls, like the bull one and the bear. Right. Any question? Anyone questions? You can just type them. All right. There doesn't seem to be any questions. So I'll probably just end it. You guys could always just type in the hub. You can DM me near your questions. We'll have probably another lesson either next week or 2 weeks from now. That's pretty much it. About to be closed for market, so enjoy the rest of the week.